Hey guys, it's John here. In this video, I want to share to you about Temple and Webster stock analysis because they have dropped about 37% from all-time high. They even dropped as low as 50%. However, this video is not a financial advice, so please do your own due diligence before you make any investing decision. I'm not recommending you to buy, sell, or hold. This is just my personal opinion, and it is for general entertainment purposes only. So, without further ado, let's get straight into it. Let's talk about the first half of 2022, which is the half year ended of 31st of December. Overall, it was a good result. They had some great growth. And just to let you know, I actually made quite a bit of money from TPW. I Forex my money. I only put like $1,000 back around the March 2020. So I pretty much Forex my money just over a year, which is pretty good. So they have got about $235 million in the first half. So I think they're on track to make maybe about $400 million in all of 2022. So 46% there, which is great. And I want to tell you about my thoughts about this revenue. So the total addressable market is about $9.6 billion. And they have got a CAGR of 2.1%, which is not high. According to this report from IBIS, you can see the furniture retailing is about 9.6 billion and 2.1% annual growth. So TPW is on track to make about $400 million in 2022. And if they can actually get the 10% market share, which is the 1 billion out of the 9.6 billion, so it's pretty good. I'm expecting the earnings per share to double the amount of what they think they're gonna make. And also, I personally believe TPW has a strong brand. They have got a pretty good website. I have purchased from them in the past and I like their website. It gives that luxurious premium brand from their website. And also, even though they could double their sales to 1 billion, and they actually have another sector that can make about $16 billion. So that's the 16 billion that they can penetrate. So if they can get another $1 billion of that, that means the revenue can increase from 400 million to about $2 billion in the next 5 to 10 years. They actually talk about that in this update. They have got a brand awareness there. The EBITDA is about 51% above the full year target. There it is. Home improvement revenue represented 95 or 4% of the group. Okay, so this is the strategy. They are doing great here. You can see the active customer growth is on the exponential. Even though the COVID has stopped, well, it still is. Still, a lot of people are working from home, but they're doing strategy. They're executing their strategy very well. They've got like a 6 straight quarter growth in revenue per active customer. They keep on investing in data and technology. They got AI. They've got 3D augmented reality. And then they've got also apps, 4.8 rating, which is good. They also have a new trade and commercial, which is the B2B. It grew 49%. Great result for them. This home improvement was, I think, a good opportunity for TPW. You can see they have got a $26 billion and about 16 billion that TPW can actually get. So if they can get like $1 billion, like 10% of it, then yes, is a good growing market. Okay, so let's talk about my checklist about the the business overall. I'll show you these quick FS. I put in Temple and Webster. I want to see the return on invested capital, 11.6%, not too bad. Return on equity, 12.2%, not too bad. The revenue kept on growing. You can see it's about 326 million, 2021. The gross margin is quite healthy. The earnings per share growth is growing. It dipped a little bit in 2021. And the return on invested equity is not too bad. My checklist was, I'm going to put a thumbs up if it's positive, in my opinion. Revenue growth is about 17% per year. Gross profit margin is 44%. Operating margin is quite low, which is only 5%. So operating margin is important because you have got your gross profit margin, even though gross profit margin made about 44%, but below the line, which is like your marketing, your staff costs, your wages, and all other things, is pretty low. And the net income margin is only 3%. That's a very, very tiny margin, because Temple and Webster already positioned themselves in terms of the luxurious premium brand. And I personally don't like this profitability in Temple and Webster. It's too low, in my opinion. So if you look at this Temple and Webster, this result is not updated yet with the 2022. You can see the operating margin is only 5.78%. Profit margin is only 4%. So it's not great. And then if we look at management effectiveness, about 12.2, put a thumbs up there. ROIC, 11.6%. I would like it to be like 15% and above, but 11%, above 10% is actually not too bad. They've got a strong balance sheet. They've got a lot of cash. Current ratio is 2.1, which is above 2, which is great. They've got very low debt, not a lot at all. So it's about 16%. The number of shares is increasing. They increased their shares outstanding in 2020, which is not great. I would like it to be decreasing. And insider ownership is only 15.57 and directors only own 3%. It's quite low, in my opinion. You can see Mark here, the co-founder, he's only got like 2.5%, $25 million worth. Conrad only got like 0.91, so that's like 3.5, 4% max. So I put a thumbs down. In terms of free cash flow, it's actually great. They made about 41%. The forward PE ratio is about 75. I'll show you my PE chart band. Okay, so if you're not familiar with this, this is a 5 years PE chart with standard deviation. If you're not familiar with on how to read this chart, I'll just quickly show you that the average forward PE, so I'm using a forward EPS, is about 47, which is very high. And then the upper band, which is this green line here, is about 82, and the lower band is 12. So anything that's close to these 12, it means the PE or the stock price is low compared to their forward EPS. This is a 5 year, so it started in 2017. As you can see, it's around 16. Okay, and then it's just shot up after the COVID. You can see it reaches the upper band and then drop, reaches the upper band and drop. When I sold my TPW, I actually didn't have this chart. I didn't create this chart yet. Otherwise, I would have sold around there when I realized it's actually very expensive. So at the moment, it's sitting around here. So even though TPW has dropped about 37% or even 50%, it is still expensive compared to their forward PE. I would like it to be around the forward PE to be on the average side, or even around the 20, around the 12 or 13. Okay, so at the moment the price is around $8.71, and if we wanted to get the lower band here, that's the stock price need to drop to around $5, which has, yeah, so imagine from 8 to 5, that's a lot further drop. We're gonna look at a different valuation. Okay, so I've got two valuation, which is the future EPS. I plug in these numbers here and I put a P multiples of 40 because that was the average. And then I just used the discount rate of 10%. And it gives me intrinsic value of $4.96. Okay, so this is, and I'm going to use three scenarios between PE 20, 30, and 40. So if I put PE 20, gonna gives me $2.48, which I put there. And then if it's a P of 30, then it's $3.72. I just put a 60% chance using the P of 20 to be conservative, and then 30% using P 30, and then 10% using P 40, and it doesn't give me margin of safety. My future EPS says it's going to be like minus 180%. There is no margin of safety there. If we look at using this EPS, but again, I'm using the analyst estimate, right? If they can add another $1 billion, they can add another $2 billion, and then add 3% EPS, then the share price may justify the high valuation. Okay, let's look at the DCF, or discounted cash flow. I put in the cash, the debt. This is using the latest financial statement. And in the last 4 years, the CAGR is about 100%. So their free cash flow is pretty good because they don't have a lot of debt. They generate a lot of cash. So if I put in a growth rate of 15% and 10%, 15% is pretty conservative. And then it's gonna give me a intrinsic value of $17. So it gives a margin of safety of 50%. But again, I'm using 40, 20, 30, 40. And then this is the numbers that I get. So using the DCF, which most people would prefer a DCF rather than an EPS. An EPS is just gonna give us sort of a range. The stock price is worth about $12. Okay, now let's look at the technical analysis of TPW. Okay, it hit about $15. There is a good support there, and the price is around $8.71. The stock price actually jumped when they got a good result, but then it dropped again. As long as TPW can break this trend, they're probably gonna be hovering around here, and then hopefully they go back up. If you hold TPW, if you believe that the share price is not gonna drop again, but then if it dropped, then there's not much support other than this around the $4.33. And then if it drops to around this price, $4.30, I'll be interested around the $4 to $5. Because if I can buy it in around $4 to $5, according to my DCF, if my average price is around $5, it's gonna give me like 74% margin of safety. But is it gonna get there? I don't know. And oh yeah, I wanna show you the Fibonacci retracement. Okay, if we look at the Fibonacci retracement up to the $15, there is a 61%. So maybe if it breaks, it may go down to around here, this area here, like this buy position between the $5 and the $6. So thank you so much for listening to me until the end. Please do comment on what do you think about TPW, how is your valuation. Please do your own valuation, and I will see you guys in the next video.